Main event for tonight, something you want to talk about, vertical focused investing.
All right. This isn't a rant, I swear. Hold on. I'm going to change my hat.
I'm a nice guy, I promise.
Take me really seriously here. Oh, this will mess up your... Oh, dear. Wait for a minute.
That should totally have been the name of the segment.
Oh, dear. Okay. I'll turn it off in a second to blind our audience, our two people. So here it is. Vertical focus firms like Energize and Intellis, and there's thousands of them out there. We all claim to get our proprietary advantage by knowing so much about our space. I'm Energize, I get to call up some of our LPs like Schneider Electric, GE, Caterpillar, call up old people at old friends from other firms and just like, hey, what are you buying today? What problems are you trying to solve? It's incredibly helpful. And you get in your head and you're like, all right, here's the chessboard and here's like the company to invest in like for like the next 6 moves.
Is that a Queen's Gambit reference that
you like that?
that you just put in?
So here's the problem. In that analysis you generate a proprietary piece of market intelligence that makes you think this asset, this company is worth more. The biggest problem that I've seen in my role around that type of thematic investing is that when it comes to the next round, you want the market to trade on that proprietary intelligence. But you also don't want the market to know your proprietary intelligence. And so unless the company has converted that secret into revenue or some other very tangible and decipherable way of value, you have this thing which is probably incredibly valuable that nobody values. And what I mean by this is it could be an incredibly strategic asset in an industry that you're like, all right, they're about to go from 1 to 5 to 10 to 50.
But nobody knows it but you.
Nobody knows but you. And it's the lesson I have is this. You need to know not what just the next round of investors is looking for, but 2 more rounds later. So 2 rounds after. Because whether you have the world's best or most strategically positioned company, if they don't look and dance and smell like an asset or a company profile that investor wants, they don't give a fuck about the strategic importance of your company. If your company has not had the ability to look like a financial profile they understand, they're not doing it. This is what I mean. There's absolutely no follow-on capital available in our space in the private markets unless you can convert your business into a financial to the income statement that these firms prefer.
This is why Aurora had success.
Yeah.
Software business.
Yeah.
They get it. Big margins.
Listen, let's play these two side by side. You are a software company for the solar market. You're the best strategic company. Let's just like, you're probably going to hit 100 million in 2 years. This is not solar, not Aurora, just a random company. But you haven't converted yet. These are the 5 things you can hear from a next round. Isn't there regulatory risk? Isn't there commodity risk? Oh, it seems like a pretty small market. Hey, kind of weird, don't know the space, haven't educated before. Hey, wasn't Clean Tech 1.0 really bad? Okay. Aurora, same company, converted it to a dramatic financial profile. And all of a sudden, everybody's willing to make the investment on what the solar market looks like in terms of doing diligence. So like that secret, if the founders had said, no, we're going to just keep investing in product for 1 more year, and we're going to market without all those financial indicators, we've been toast.
I want to get into a little bit here how you coach founders and executive teams through this, because I think you probably feel this pain more acutely than we do. Because I think the opposite is actually true at the seed stage. And I'm going to use carbon capture as an example, where people hear the buzz and the potential, and you don't have to have the proof points yet. You just have to know it's a big market and you like the team. It's typically what you need at the seed stage. People go, oh shit, this is coming. Let's put a lot of money into it, see what happens. Let's raise the prices. Who cares what we pay for it? It's a big market. Let's do it. And then they get to the Series A and they're like, well, why have you only converted 2 customers in the last 18 months and you have 9 pilots?
Yeah.
So that's how these companies operate. And so the Series A companies at that point and Series B firms start to say, well, we're not funding this. So how do you think about coaching entrepreneurs, getting ready for that, saving cash positioning their balance sheet, et cetera, because you know this is coming?
If hope or luck is not an option when you're financing, you in the current private market, and it's still, again, like the earlier stage is still far more fluid than in the past, you will not be able to raise your round unless you have demonstrated some version of commercial readiness and income statement proof that shows that you know what you're going to look like when you grow up.
Mm-hmm.
In other verticals where it's been proven time and time again that you can do zero revenue, like the traditional social worlds, until you flip the switch, and then you can make a boatload. Absolutely. And people believe that. They know
captive audience, right? You can monetize a captive audience.
In this space, if Aurora's the same business, whether they had done that or with monetized from the start or recently, but there's not enough proof points to show that you can that the indicators are non-financial.
Yeah,
the stepwise indicators are non-financial, and so you're forced to play by what's one of the main lessons I teach everybody at Energize. Play with the hand you have, not the hand you want. And this is the problem that most first-time sustainability technology entrepreneurs run into, which is they're like, well, this company is about to have a lot of value, and you don't realize that in the field you're playing on, which is it's the field that has holes in the ground and just it's not the perfectly smooth field. You need to have proved 2 or 3 different points of commercial traction, even when you probably shouldn't have to.
Yes, something's only worth what someone's willing to pay for it.
Yeah,
and the thing that I think is going to get people in trouble here, especially at the early stage, if you take money from early stage venture capitalists, generalists, we see this a lot. Companies raising 12 months of capital because that's what the West Coast, East Coast firms want them to do. That's what they've seen in software. That's what they, as they come into climate, that's what they want you to do. That's not how these businesses work. If a sales cycle gets pushed by a quarter, which happens in the utility and the energy space, the industrial space, you're dead at 12 months, right? And it's not long enough for you to convert some of those pilots and start showing, like you mentioned, showing some of those indicators to the Series A and B investors. You can't do it in 12 months.
Yeah.
The other thing that I think is super interesting, you're talking about this, Third Derivative today announced their fund, and one of the quote, or their initiative, their incubator thing, and one of the quotes in Axios was the VC model doesn't work in energy and in climate tech. And I actually take exception to that because I think that's not true.
Yeah.
I think if you do it as if it's biotech, and stay with me here, it doesn't work. Biotech takes really long to develop. But if you get to the end and you get through all the regulatory filings and you get a patent and you get something that's protected for 10 years and a winner-take-all market, the sales cycle or the development cycle no longer matters because the position at the end is so strong.
Yeah.
That's how people are funding energy companies, except you don't get any of those defensibility. You don't get any of that moat at the end. It's largely not winner take all. It's winner take 4 or 5. And while that's still an oligopoly and people think that's the same, it's not. It's 4 or 5x bigger. That means you have 4x the competition. And we're really bad in terms of thinking in multiples as people. And I just think if you're funding it like it's biotech and you're expecting the long cycles, but you think the payoff's going to be just as big at the end, you're wrong.
Yep.
And so like there's just not a model there. And so like if you fund it like it's that, then yes, you're right. Like and we've talked about this. So like if you're funding battery technology and it takes a lot of capital to get to the end, everybody gets diluted in the same way that you would in a biotech company. But guess what? There's a lot of fucking storage companies out there. There's a lot of battery companies out there. And it's just not the same thing. And so like it's the whole like to the man with a hammer, everything looks like an L.
So let me ask you this question though. What I'm saying is you kind of need to prove commercial, and then some businesses just it is zero until the day that battery is installed in the operating grid. That's never going to happen, right? The early revenue is never going to happen, which is maybe why SPACs are coming forth because for those opportunities, because the private market just wouldn't fund it. And I think it's a good idea in some cases. So do you, in that case, like who's the funder? Who's the funder between the seed and the SPAC in your mind? Who's the best funder?
It's not a venture. It's not a venture firm. I mean, to me, it's just. Do you think it's a venture? I mean, is it a venture firm to you? Is it a Venrock? Like what they've done with healthcare? Does there need to be that for energy, where it's somebody who is just willing to take a zero for? There's not an ecosystem there though.
So Venrock is a great example because they're incredible in that world. And then there's another. There's one here in Chicago. What's it called? I'll know it in a second. Come to me. The issue is this. There's a phase 1 trial, there's a phase 2 trial, there's a phase 3 trial. There's an arbitrary system, not arbitrary. There's a government system that denominates when a technology has progressed.
That's right. That's a great point.
Evaluation step points. There's no such thing in the technology, in the energy technology world.
That's right.
If there was such a thing as this battery is moving from a stage 1 to stage 2 to stage 3 technology, it would happen. And it kind of does now. With like, oh yeah, the proof concept worked, and like now it's not just like in a chemistry lab; it's in a mini like production facility, and then production facility to like a cogeneration at an industrial plant. But like honestly, if you want to talk about like how do you spur this market, I feel like there has to be some sort of legislature around.
That's a great point. There's no signaling. There's no independent signaling.
Yeah. And like, by the way, I wouldn't say that our healthcare is like the best thing to model after. But it's still the best research and development organization.
Yeah.
Outside of
the flip side of that is that innovation can't get to market as quickly.
Yeah.
That's the trade-off, right? It gets funded, but maybe doesn't get to innovation as quickly.
Yeah, you trade off funding. There'll probably be 50x more funding for these ideas, and 10x, slower. They're already pretty slow. So like, I don't know. I feel like for this world, because there's less capital, it's already so slow. So it's probably the same length and just better benchmarking.
Yeah, that's a great point.
So what should we call it? Should we call it the Tough Stevens benchmarking stage 1?
Yeah, there you go.
Yeah.
You're at TS1. You're a TS1 company. Yeah, but I mean, that's a great man. It's a great point. And this segment should have been about signaling. Like what you talked about at the beginning was you have to signal to funders that you look like businesses that they're familiar with, and that we maybe need an institutional system for the harder shit.
Yes.
That signals to investors. Like investors need signals. We're lemmings. We're not, despite how brilliant we want to think we are on Twitter and our blogs, like everybody needs a signal, right? They need something.
Yeah, it's a good summary. It's a good point. It's your proprietary knowledge needs, and this is with battery technology or a software company, needs a way to convey progress. And if it's not going to be an income statement progress, like strategic positioning for a software company or technology advancement for a battery technology. If it can't be an income statement, there's got to be another way. And right now the system is failing because the other way is just there's nothing, there's no parameter. It's cachet of investor. It's cachet of university that has endorsed it, which to my knowledge has been no correlation to success in this field. So yeah, some other standard to set progress.
So I really want to leave it there because I think we have a good summary. But I do, to putting you're competitive, you're competing for deals, and what you've just said is that I can bring all the strategic advantage to the market or to your company, but unless you can convey it to the market, it doesn't mean anything. When you're trying to get into a deal, without giving specifics, because I know one of the things I love about what you guys are doing, like you just did Matrioid, and Beekeeper, they all have kind of other industries where they're playing. How do you sell that to an entrepreneur? Like you're telling them, like, you need me because I'm going to get you into this vertical, but unless you can convert this vertical into something that an investor recognizes, my strategic help may not be as important.
Yeah, I think it's a dangerous question.
Yeah, and we don't have to. I can cut this out, but
no. I want to answer it. The entrepreneur is going to pedal as hard as they can, regardless. It's the great investor's job to put you in the right gear, to know right gear, and also the right direction to know where you need to, where's the next stop, where you're going to need to park the bike next for a little bit of time, because whether it's a metric or some other market known point of progress. Some companies get there and some companies don't.